Today we are analyzing HP Inc., ticker HPQ. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. The company has a market cap of $30.8 billion, enterprise value of $39.2 billion. See almost $8 billion in debt on this business. That's actually quite a significant amount. You're looking at a little over 20% of the overall enterprise value in debt. They're operating in the technology, hardware, storage, and peripherals industry. So HP was formerly known as Hewlett-Packard Company. Changed to HP in 2015. So they produce computing, other devices, imaging, printing products, personal systems, printing, and corporate investments. So HP is the brand name. I've owned HP products in the past, used HP products. They have a lot of computer-based type products. You're talking desktops, notebooks, like laptops, workstations, mobility devices, point of sale. You got displays, software, basically everything that goes into the hardware of computers, printers, different things like that, graphics and different supplies stuff. You see printer hardware here. So pretty interesting company in terms of where the space is. Let's see how they actually turn out. Beta of 1.01, almost exactly the volatility of an average S&P 500 company. But we go down the return on invested capital chart, which can tell us a lot here. So it looks like they lost money in 2002, of course, which was a recession. They lost money in 2012. But otherwise, they've been profitable 18 out of the last 20 years. That's pretty good. What I like the most about this chart here, though, is the clear stability. Year to year, you don't see a lot of changes. Very flat numbers here, although I think the chart's a little distorted by these last 6 years where it jumps up so much, so you kind of miss some of the volatility here. There is some fluctuation, but you see numbers like 14%, 16, 16, 13, 14, 10, and then from 2013, 10, 10, 10, 10, 12. So you got some pretty stable numbers here from 2013 to 2016. However, starting in 2016, they jumped up to 68% 2017, 109%, 67, 64, 111, and 40%. So some very strong return on invested capital numbers over the last decade. Very impressive numbers here. Actually, very good performance since 2013 for this whole period I'm looking at. So excited what I see from a return on invested capital point. We see 52% return on invested capital that easily surpasses my target of 10% plus. Return on equity, I'm usually looking for 15% plus. I don't know why it's negative here, but since we see negative price to book here, I'm going to assume they have a negative book value. So this number is actually pretty good. This is just a quirk of how that calculation would work. If you have a negative book value, it's going to make the return on equity look very, very high. Simply how those calculations work. But overall, this tends to be a good sign, a positive sign of the type of business that's being run. Relatively high quality, because that can only really be achieved through buybacks above book value. So when they execute something like that, that's what you're going to see. So I like how that is turning out there. Overall, signs of a really good business here. We're seeing a quality business. The price seems relatively cheap. Price to equity of 11. Of course, the average S&P 500 company historically would be a PE of 15. And I've already said this is probably an above average business, and it's trading at a PE of a below average price. Price to sales of 0.5 suggests that this isn't inherently just like earnings being, a one-time high. All of these numbers suggest it's probably a relatively cheap price. The only thing that doesn't, of course, is this declines in revenue. You have massive declines in revenue. Now, we can see $112 billion in revenue in 2013, but it falls off completely to $56 billion in 2014. But then it's pretty stable in that range from $56 billion in 2014, growing to $62 billion in 2022. So that's not a lot of growth, but it does mean since 2014, the business has been growing. It does make me think there was some sort of business sale or spinoff or something from 2013 to 2014, because that's just an abnormally large drop in the price, in the change in this business here. So something I'm being aware of here that I wouldn't necessarily expect. But you do see some further declines still for 2 more years. Declining 56 billion, 51 billion, 48 billion. And then you've kind of grown since 2016. 52, 58, 58, 56, 63, 62. So we have had some growth in this business, but it's not a lot. Even going from 51 billion to 62 billion over the course of 7 years, you're only growing about 20%. You're talking about 3% type growth, and it's not really stable. You're not growing every year. Some years have declines. Why is that a problem? Well, when you have declines, it's very difficult to manage a business that's periodically having decline. The easiest businesses to manage are the ones that can grow each and every year, even if it's a low, stable amount. So when you don't have that sort of growth, it's hard to predict, harder to manage your costs, things like that. So you can see your operating profits declined since 2013, but it's up since 2014, 4.4 to 5.2 billion. EPS was $2.62, up to $3. You did mark $5 in 2021, but that seems out of the norm. This $3 mark is kind of a little bit more in the norm of what I might be able to say expect. But I mean, it's jumping around all over the place. You have a lot of years with declines. It's going to be hard to predict this business in the future, I think. You are paying a dividend. It's maybe like a third of the overall, stable earnings. So you're going to get $1 in dividend yield. That's going to be maybe 3% dividend yield on this business. That's pretty good. Let's see. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. Let's go look at the income statement to get a better idea. You see this big drop off here again in SG&A from 2013 to 2014. This to me kind of would solidify, hey, there was a big, org change, because you don't really see stuff like this with that drastic of an SG&A change in a single year unless there's a massive change in the organization. So that's what I think happened here. Overall, they've managed the SG&A decently well, $5.3 billion down to $5 billion. That's allowed them that, although the gross profit has been stable, they've also been able to maintain stable operating profit, but you're not really seeing a lot of growth. Net income looks like it's collapsed. Why is that? What's the big change here? $3 billion. You had a lot of other non-operating income losses. So anytime, it's always difficult to understand a business when you have big numbers on this other non-operating income line. They also are paying a lot on that debt. That debt's very expensive on a business that's declining. You have to be very careful with debt on a business that's declining, because this interest expense can over time take up an increasing amount of the overall operating profit. So far, it's still not a terrible size, but it does mean that you have an expensive amount of money being spent there. Now, the thing that I like the most when I look at this is just look at these shares outstanding. You've gone from 1.95 billion shares outstanding down to 1 billion shares outstanding. You've retired somewhere in the range of 40 to 50% of your shares outstanding in a single decade. So you're talking about an extra 4 to 5% per year boost in the EPS rate simply based upon those buybacks. Now, the problem is you basically needed that because the business has been struggling during that time frame, but it does mean on years where you do have some nice positive one-time earnings, you get these really big boosts in EPS. But it does mean some of this volatility is coming from this other non-operating income line. You're a little bit more stable on just the operating profit line, but I like how much those buybacks were done. PP&E. Again, you see here this big drop in goodwill from 2014 to 2015 only really comes from something like a sale. A big drop in PP&E, 11 billion to 1 billion. Massive reduction in the assets being used. You're down to 28 billion in assets here. Much less capital intensive. That's a really good sign. You like to see that when you're owning a company. If they can maintain or improve their earnings on much fewer assets, that tends to be really good. You see this $10 billion in debt is really high. You have more debt than your PP&E. Well, basically your PP&E plus inventory is your debt. It's just still really high debt for a company of this size. About 4 years. It's highly leveraged. Highly leveraged. Okay, so you see these buybacks each and every year. Dividends paid each and every year. But the problem is that they're taking on this debt to continue paying some of these buybacks and dividends. They're being very aggressive in their management. You have stock-based compensation here, so that's offsetting some of your buyback. You're investing much less PP&E here than you used to, which means that your future could get better from a depreciation standpoint. You see those numbers have come down a little bit over time. You're still spending a lot on that, but not terrible. I mean, I think the problem for me with this company, the balance sheet seems to have been managed decently well. You've reduced your asset intensity. That's a good sign. You have a negative sign that you have some higher debt than I'd like to see on a business of this size. But again, it's being managed with the reduction in the asset intensity, so that helps. That's boosting these returns on invested capital. The big problem that I would have for this business is even if you just look from 2014 to 2022, you're not growing very quickly. You've grown somewhere between 10 and 20% over the 8 to 10 year period we're talking about. That's very low growth, 1 to 2% growth per year. You're getting a boost in your EPS growth, 4 to 5% because you've done all those buybacks, and you have a relatively cheap price, so that allows for more buybacks in the future. It's not exciting. I don't see an easy path to get double-digit returns when I'm not growing that fast. If we say, okay, we got a 3% dividend, we get 2% revenue growth optimistically, so that's 5%. We get an extra 4% from our buyback. Maybe that puts you at a 9% return. That feels optimistic, and I really want these double-digit returns. So for me, I'm going to pass on HP because I don't see a clear path to get to that double-digit returns. It's an above-average business here, but they're not growing. They're not able to reinvest at these rates of returns, so they really don't matter to me. It's good that they've been able to pull that capital out of the business. That's really helped over the last decade, but I don't know how repeatable that is in the future. It's a reasonable price here. You could certainly make money on this stock, but it's simply not a good fit for me. If you enjoyed this video, hit that like button. Don't forget to subscribe. Check out my watch list stocks. Those are my favorite ones of this series that I've looked at. The link to that playlist is up above. And the link to quickfs.net, which is this software that I'm using, is in the notes below. So just go down there. The first link in the notes below is to quickfs.net. That's my affiliate link. You can support the channel by signing up for a free or paid account there. And I can get a commission when you sign up through my link. Thank you for listening. Until next time, stop paying fees, start building wealth.